Good afternoon, everyone, and welcome. I'm Shannon Durejo from Creamer Media Webinars, and it's great to have you with us for today's discussion on South Africa's automotive industry. We've brought together an excellent panel of experts who will explore what it will take to strengthen the country's automotive value chains to stay globally competitive in a changing market. A big thank you to our sponsors, Nedbank and MetAir, for their generous support in making this important conversation possible. Before we begin, just a few quick housekeeping notes. You'll find the Q&A box at the bottom of your screen. Please post your questions there at any time. Our panelists will do their best to cover as many as possible during the discussion. The chat is open for your comments and insights. We encourage you to share your thoughts there. Just remember, questions go in the Q&A and conversations in the chat. This session is being recorded and we'll share the link with you afterwards. We're also streaming live on YouTube, and that link will be posted in the chat once available. With that, let me introduce today's facilitator, Hugo van Wyk, an Associate Director within EY Africa's consulting business, where he forms part of the business transformation team. He's led many projects in the automotive sector, including tire manufacturing and aftermarket, advising on localization of value chains, differentiation strategies, and leveraging AFCFTA opportunities. Hugo will guide the conversation with our distinguished panel, consisting of Tsetle Liteko, the Chief Policy Officer at NAAMSA, the Automotive Business Council; Beth Dealtree, Head of Policy and Regulatory Affairs at the National Association of Automotive Component and Allied Manufacturers, or NAACAM; Professor Justin Barnes, Executive Director at the Toyota Wessels Institute for Manufacturing Studies, or TWIMS, and Amit Singh, National Manager for Manufacturing at Nedbank. It's an impressive lineup, and we're looking forward to an engaging discussion. So, Hugo, over to you to lead us through today's conversation.
Great. Yeah. Thank you very much, Shannon. Thank you for everyone for being here. It's a pleasure to be able to facilitate this great panel. And I think, just to give a little bit of context, today South Africa's automotive sector stands at a real crossroads. We're facing global shifts in technology, sustainability, and trade. And in fact, we're in the middle of a great era of disruption, and this industry is feeling that disruption. Now, we know our industry is vital for jobs and exports, but for us to stay competitive going forward, we're going to have to rethink and really adapt quickly and build stronger local value chains to support this industry that is so important to us. So as Shannon's mentioned, today I'm joined by a panel of experts in our industry across policy, manufacturing, research, and finance, who will help us unpack not only the challenges, but very importantly, we need to discuss and understand some of the opportunities that lie ahead. So we'll be discussing policy, localization, technology, and investment. So, as Shannon mentioned, please do share your questions and insights in the chat. But for now, let's get the discussion going. Let's dive straight into it. And I think, I'm looking forward to hearing more from this panel and understanding and starting off with, let's get a view of the current state of South Africa's automotive sector and what are the real drivers and mechanisms that's shaping it at this juncture. And I'm going to start with you, Tsetle. In terms of from a policy point of view, how is NAAMSA really working with government and industry partners to keep policies competitive and aligned with global shifts toward electric mobility?
Yeah, thanks for that question, Hugo, and good afternoon to everyone joining the webinar. I think that from an auto point of view, I think we were the first sector in the economy through the DTIC to have a master plan. And with the use of a master plan, it's easy for us then to almost segment what our must-wins are. And the master plan, in how it was structured, drives these type of conversations. So if you check the SA Auto Master Plan, and we call it SAM 35, because it's got an outlook towards 2025, it's divided effectively into three themes. One, how do we create a thriving local industry by driving demand for the products that we are producing? And so that demand pillar then has two focus lanes on it. One is how do we locally create demand for the vehicles we produce, and how do we create regional demand into the continent for the vehicles we produce? And then we looked at the concept of industrial development within SAM 35, and we said, how do we then localize content such that we could get to a place where South African suppliers and South African OEMs are informing 60% of input into the vehicles that we produce. But how is that production itself anchored on a thriving local infrastructure that's able to facilitate the movement of our products from conception to manufacturing all the way to port exits and port entry, and how infrastructure supports that. And then how do we create an inclusive environment where transformation, skills, and to an extent, technology advancement form part of broader community inclusion, and those community members could look into our industry like that. So SAM 35 is the basis through which government interactions can be driven, and we're driving it. It's got a review process, and it's got a midterm review framework. And in the midterm review framework, we could look into this particular framework every 2 years to see whether or not it's driving South Africa forward, or or has there been any market forces that have forced a change, and from those changes, we need to pivot the strategy itself. So for being an industry and the first to have a master plan of its kind, and the first to have an executive oversight framework to the master plan, and in this executive oversight framework, the Minister of Trade and Industry oversees conversations around how far the master plan itself is developing. I believe that NAMSA and other the auto industry are able to discuss at least and put into plain understanding what dynamics are driving policy adjustments and policy, the need for policy changes and policy interventions. And I think to answer your question, having a master plan that all partners and social partners agree as a framework, and we all agree on how we monitor that master plan's performance is key towards how NAMSA is ensuring government understands the need for policy interventions and policy relevance. So thanks. Yeah, I hope I answered you, Hugo.
Perfect. So, as you say, the framework is the base that we can use to have that discussion with governments and ensure that the policies are being built on top of that. And you kind of mentioned this this need for the creation of an ecosystem where local demand will be driving the need for local suppliers. It's this kind of ecosystem that needs to be start getting built. And maybe I'll go to your side, Beth. What progress has been made in terms of local supplier development and localization, from what you guys see on your side, and what challenges still remain on that front?
Thanks, Hugo, and afternoon, everyone. So I think supply development and localization was very interlinked, two very separate concepts, and two that have had fairly different trajectories, I think, in the past at least 5 years, but certainly probably longer than that too. So if we start on the supply development, I do think from a South African perspective, we are seeing some level of progress there. I always say it, I think we have some seriously world-class manufacturers that are based in South Africa. With the right operating environment and volumes, you'll see them competing with the best of the best, and that's why we integrate it into a global value chain. If we look at some of the programs that exist, for example, ASCII, they are rendering positive results, and I think there's a fair few benchmarks which have suggested that at the top end we certainly are, if not meeting, exceeding benchmarks from a supplier development and capability perspective. Does it run the whole way through the value chain? No, is the honest answer there. I think there is a lot more to be done in terms of supporting largely the scale, but in that the development of particularly tier 2, tier 3 type suppliers, and with that also your raw material suppliers. But that's the supply development section of it. If you look at localization, if we're being frank with ourselves, that hasn't really developed too strongly over the last decade at the very least. As Tetle said, we've got the Auto Masterplan, and that set out a target of a 60% local content rate. The target was by 2025 would be at around 48, 49%. And the reality is for the last decade plus, we've been sat at 40% on a good day at an OEM level. Within the tier 1 base, it's about 50 to 55%, varying by quarter. But the reality is that's where I think we're struggling to see a level of growth. And there is, as Tetle mentioned, there is a policy review that needs to be happen or is scheduled to happen, which should hopefully address that. But I think certainly for my constituency, and I represent the component manufacturers, if you were to say to me, has localization progressed? No. Is that our biggest challenge? Absolutely.
Okay, great. So and thank you for that view. So localization remains a challenge, and I think we definitely, with those numbers that you've mentioned, they're definitely aware of that. And maybe Justin, I'll throw it over to you then, with your extensive experience in the global value chain research. How would you assess the resilience and competitiveness of South Africa's automotive value chain in this current global environment?
Thanks, Hugo. Good afternoon, everybody. I agree with Beth. I think that we've got pockets of excellence in South Africa. I took a group of industrialists to Thailand in November last year. We visited a whole range of competitors, and it's really interesting. They've doubled the volume and half our complexity. But from an operational capability and operational efficiency perspective, no different to our plants. What is fundamentally different is they operate in a much healthier ecosystem. So the infrastructure works, the energy works. It's a much safer environment in which to operate. It doesn't come with all of the extensive factory protection costs and everything else that we deal with in South Africa. So we are equal in relation to what we're doing in our factories. We are far behind in relation to the operating environment in which we find ourselves, which of course has a challenge, because it means that within the global families, within these global value chains, we tend to be positioned more at the margins and further away from the core of the value chain. And that has consequences. So if I think of the master plan, our domestic market has not grown. Our regional market has not grown. Our domestic market has become poorer, so there's a buying down trend. And there are a range of new importers who are very aggressively eating away at market share for the local producers who produce for the local market. The African market has not taken off despite lots of opportunities. So there's no growth. And the consequence of that is local content cannot go up. So everybody who we compete against, Thailand, Mexico, Malaysia, Turkey, they can all get high levels of local content, but only because they go above the 1 million units a year mark. So the master plan is supposed to have a 1.2 million unit domestic market by 2035. No chance. We're supposed to have 1.4 million vehicles of production by 2035. No chance, because it's tied to the size of the domestic market, because all of the incentives are built around rebating the duties for the size of the domestic market. So we're in a vulnerable position, but we have a formidable and very capable automotive industry, which is proving resilient and ensuring we don't see serious decline, but we are not seeing growth. The industry has stood completely still since the launch of the master plan. There's been no growth on any of the parameters, and I measure manufacturing value added, employment. So we can tell a good story. The reality is we've gone sideways in terms of the numbers.
Sure. Okay. Thanks, Justin. So I think there's some really interesting points there, and maybe I'll touch upon one of those. As we pass it over to Amit for a further talk about the funding side of things. But you mentioned the ecosystem is one of the enablers, and that's required to support our operating environment. So maybe that ties in well with what I want to ask you, Amit. What types of funding mechanisms or innovations are needed to support localization, the technology upgrades, looking at the sustainability? How can we achieve that?
Hugo, thanks for the question, and good afternoon, everyone. I think it's an interesting question, Hugo, and there's very many parameters to look at. So one can look about, is there really innovation required to bring some gust of wind into the sector? And I don't necessarily think so. I don't think we need anything innovative from a banking perspective, from a product offering perspective. I believe our set at the moment, our product set at the moment, can get us from where we are to where we need to be. Where I do foresee a big gap is actually understanding the sector and the entire ecosystem and value chain. Something that I've said for a long period of time. As a bank, we need to understand as to where do we play within the sector. Do we want to do stuff that are not adding value or not adding benefit? Do we want to remain to be a talk shop? Or do we want to be involved with industry stakeholders in actually making a fundamental, tangible difference? And that's something that I'm quite passionate about not just being a talk shop at Nedbank and making tangible differences everywhere. So So what am I actually saying if I'm not talking about products? I'm saying, well, products are there and thereabout with all the banks. They are no different. I think the one thing that's really utmost important to understand is we need to serve as a conduit between public sector and private sector. We need to fund for those bridges that we are inevitably going to cross with understanding what is the current landscape and where is the landscape going to. And without that lens and without those partnerships and those relationships together, with the likes of NAMSA and NARCAN and the likes, we'll be doing the entire industry a disservice. I think, Hugo, the one part that Justin had made mention of, quite easily so, is that this ecosystem needs to be conducive for growth. While we have world-class innovation, while we have world-class production facilities, and again, I challenge anyone to go to any of our OEMs or any of our component manufacturers and have a look at their facilities. It's absolutely top-notch, but it needs to be supported by policy. It needs to be supported by a certain amount of motivation for local manufacturers to actually deliver on the volumes that are required. I think the place we find ourselves at now, which is somewhat scary, is I find that while, as Justin rightfully mentioned, we've moved sideways in relation to the master plan, I fear that we might be moving somewhat backwards with new entrants into the market, other brands coming to the market. What is the sense of our current OEMs, which we should be supporting, that are in the country? Are they getting the necessary support? And again, that's quite a loaded question to ask, but I think it's one that we need to ask ourselves now, prior to asking ourselves, why did we fail? But I think as a bank, what's important for us is not necessarily the funding mechanisms and funding tools, is being that financial partner to the sector and industry and understanding the nuances and solving for it within that value chain and ecosystem, and not necessarily just doing the finance of advanced machinery, to aid in production efficiencies. Yes, we can do that, but so can our competitors. But what does advanced machinery mean for that particular business? What's the uptime and downtime? What's the commissioning costs? What's the capex required? When you have product changeovers, and I think that's the deeper questions as Nedbank, which is something that we endeavoring to do, is not do something at face value and do it with full intent of supporting local industry.
Brilliant. Thanks, Amit. Yeah, and policy seems to be a bit of a theme that comes through many of these different answers. And I see, Tetla, you're nodding your head there. And maybe I'll come back to your side then. What are the big kind of policy interventions that you see would really accelerate this going forward? Where do you see what's the focus area on the policy point of view that we need to get into?
So, and Hugo, it's an important conversation. I think if we aligned ourselves on what would be a primary goal for any policy support that we would push for from government and in this ecosystem that we're trying to build, it would be one, how best do we drive up volumes, whether it's volumes we are able to produce or it's volumes that we are able to translate in terms of opportunities for our supply chain to supply into OEM through localization. So the volume question is actually the biggest question we are always going to be solving for. And it starts with first convincing those OEMs that are locally manufacturing to commit to model allocations. And if continuously create an environment where we will have local model allocations into South Africa, and because model allocations comes with OEM investment, and then from OEM investment, the possibilities of us attracting tier one suppliers and those tier one suppliers creating a value chain that's able to promote tier two, tier three suppliers all the way into this local content-driven intervention that we're driving from a policy point of view. So volumes drive all types of conversations in terms of why we need policy interventions. And policy certainty requires that a government understands that they are partners with OEMs in how investment is driven into our local economy. It requires that the incentives themselves are predictable. And so whilst that predictability is always shaken by adjacent policy frameworks. And when I say adjacent policy frameworks, I'm not dismissing the importance of those adjacent policy frameworks. So something like transformation, for instance, it's an adjacent policy framework that could make the incentive programs not predictable. So we need to always make those adjustments to make sure that that predictability of these incentives is always at play, competition rules and so forth. But That said, if we are concentrated on how well we create a predictable policy environment locally that drives volume up and that drives demand for locally produced vehicles. And I'll give you an example for one. We've been aware as a country now for almost 5 years that our primary export destination, which is the EU, have a sunset on ICE demand, and they're going to move towards NEV production. And this NEV production supports demand for plug-in hybrids and BEVs. And to still have an environment in SA where we are yet to finalize effectively what they call infodocs, the rules of engagement on how government would support EV production, and to still have that as an outstanding conversation creates that uncertainty. And so it's those type of gaps and lags that create a challenge on how we have this volume conversation. And that is for us a must win. Thanks.
Okay, so so we're saying that the correct policy with government must drive the OEM volumes that must come into the country, local production. So I think that's a good point. You know, we need those volumes, and that creates the fuller ecosystem, the value chain that we require. So Bess, maybe I'll come over to your side. You know, understanding what would be the policy priorities for you to develop that component side of this value chain. What's you know, we've seen the driver from a NAAMSA point of view. Is it different on the NARCAM side, or are you still aligned to that?
Look, there's a level of alignment for sure. So I think we fundamentally agree with NAAMSA and with what Tetle is saying and what Justin was saying around the need for volume. The automotive industry is really governed by economies of scale, and unless we get the volume, it is particularly hard to really progress localization. And so in that sense, we fully aligned. I think the APDP2 review, we've had many discussions offline about it, is the need to, how do we protect a domestic market and how do we grow our domestic market, get consumers buying locally built vehicles to grow our volumes, and with that, see it translate into localization. That being said, I think where we maybe, I don't want to say we're different or we stand apart, but I think from a component perspective, there's more to it than solely solving for volumes. I think at present we're sitting with a policy program that really benefits assembly more so than local value addition. And so as NARCAM, that is something we certainly want to see amended, is how do we actually drive localization? The reason I say this, I mean, if you look at some of even the higher volume OEMs, there's quite a substantial range in each of their local content levels. Some are sitting at the mid-20s and some are 50%. There's a level of argument, and Tetle may want to question me on some of the numbers, but the point is there's a range, which suggests there is a capability or an existence of local capability. How do we close that gap? And so beyond just growing production volumes, I think what we also want to see is, well, how do we encourage either bottom-up competitiveness? How do we get components as competitive as is physically possible so that OEMs are naturally buying them rather than trying to incentivize the OEM to localize? And then equally, I think a kind of a consideration that we're toying more and more with is, if you look at the Thailand case and their transition to electric vehicles, they had a really interesting policy, which effectively, without getting too specific into it, ultimately started to mandate a level of local component procurement. So if you wanted to be selling and producing in Thailand over a specified period of time, there was a requirement to localize the battery or a couple other high value EV components. And I think that's a really interesting potential policy for South Africa to pursue, to say, where do we have really a strong competitiveness? Where do we have a capability? And what do we do to say, well, we're incentivizing the OEMs, we provide a significant proportion of incentives. What is the get back for South Africa? And ultimately that comes from localization. That's where employment sits, that's where economic value add sits. And so how do we start to mandate that outcome so we really are pushing closer to that 60% mark rather than hoping that it trickles down into the component supply base?
Mm. So you're saying that in the current environment, with the potential of a few, well, not maybe a few, but some policy reform, there might be some quick wins that's available, that's on the table, just with the current players that we have in the market. For
sure, absolutely. I think there's a lot of, yes, there is a fundamental review to happen, and that might have a much larger change, but I do think there are certainly some quick win type of activities. And I think you can see it maybe where South Africa is lagging a bit, is if you look around the world and how a lot of global economies are responding to what is a rapidly evolving auto industry. What they have is the quick wins, right? They're doing the the relatively small changes, but they're doing it quickly and it has a big impact. And I think that's maybe where we are lagging behind. I think as industry, we've all identified some quick win activities, but we need to actually now enact them to really stabilize the sector, and then let a full policy review then kind of lead from there to say, do we need to have a fundamental change beyond that?
Yeah, absolutely. With things changing so quickly in the industry, there's no time for us to kind of lag and wait many months, years to catch up. Movement has to happen now. And so, maybe Justin, I'll come over to your side. You guys were so influential in shaping that automotive master plan. And so I would like to understand, where we stand now. Where do you think are the kind of real key critical adjustments that will have to be that's required to that master plan for us to be able to catch up and just stay up where we need to be?
So I think, first of all, we have to understand the issue of volume, right? The volume is a priority. The challenge is it's a priority across the global landscape. We are in an environment where there is far more production capacity globally than there is global demand. And the way in which many economies are responding is to make it more difficult to sell in their environment. Hold that equal, it means that the countries who are doing nothing to make their environment more conducive for local supply are being targeted by those who are looking to shore up their own domestic market position and export as much as they possibly can. So there are certain locations which have a much greater propensity towards import absorption. South Africa is one of those countries. That's problematic in other countries, but many of the other countries who have the same problem as us do not have 30-odd% unemployment and low levels of productivity and declining gross fixed capital formation and all the other good things that make for a successful society. So we've got a double whammy here. We've got the issue around the socioeconomic environment, and we've got the fact that our market is very attractive for import penetration. So here comes the challenge, because there's industrial policy of the narrow, and then there's industrial policy of rather automotive policy of the narrow, and then auto policy that's broader. So automotive policy in South Africa is the custodian of the Department of Trade, Industry and Competition. There are tariffs, there's a production incentive, there's a volume assembly localization allowance, there's an automotive investment scheme, and there's a package of support that the industry is provided. You can go tick, 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 question mark, tick, but by and large, it's a robust, well thought through, well considered, well balanced policy. The problem is that sits within the broader policy framework. Our vehicles are overtaxed, especially interestingly at the lower price segments. We have this completely inverted market structure where our ad valorem tax is comparatively, by global standards, far too high for cheaper and middle price vehicles. So in South Africa, if you're driving a 4x4 Fortuner or you're driving a Bugatti Veyron, your luxury tax is exactly the same. So there's a real structural problem in relation to the tax regime. And then, of course, every local government sees the automotive plants, whether they're the vehicle assemblers or the component manufacturers, as a cash cow to essentially be used to cross-subsidize everything else in their community. So you've got this massive burden of cost occurring at a localized government level, which essentially undermines the narrow policy. And instead of the narrow policy becoming a policy of growth and development, which is what it was intended for, it becomes a policy of compensation to try and make up for all of these other challenges that we're experiencing. So we have a major issue in the market, and we have a major issue, especially at the local government level, in relation to the sophistication of the operating environment, which is not up to the standards, not even close up to the standards of what the automotive industry requires.
No, that's quite interesting. So, you're outlining there the cost and the burden that's carried by some of the local value chains and the manufacturers and this industry in South Africa. And so, I'll come over to your side. How do you see financial institutions supporting the competitiveness? Because you've got all these imports that are cheap. Our local guys need to compete. They need to integrate into those value chains, but they've got all these other elements at play. Are the financial institutions playing a role to be able to make life a bit easier for them, support them, enable them?
Yeah, Hugo, it's a tough one, because on paper, it doesn't look good. I mean, if you listen to Justin, As a banker, I want to hide under the table and think, well, should I actually be on an autos webinar, considering where we are as a sector and as a bank? It's important for us to mitigate risk. But I think where the difference comes in, Hugo, is as banks and financial institutions, we can't think about instant gratification and the immediate turn, and are we going to show profit for investment in this year? I think the lens we need to overview is going back to the start, is where have we come from as Autos SA? What is the potential and productivity potential that we have, to Justin's point earlier on? We're underproducing for a number of various reasons. So what's the potential of the country? And where do we see ourselves now? If we take that lens on, the obvious question is, does policy support that? Is the trajectory moving to the direction where we can mitigate a risk for lens within the space and sector? And I think that is often unknown to us as bankers, but that is where the importance of relationships with the likes of NARCAM and NAMSA come into play. So those insights that they would share with us relative to specific spaces, specific sectors, we can apply that in our modeling, because modeling is very simple. It's a plus and a minus, there's numbers, there's figures. But I think what's more important for us is to understand the story behind this particular manufacturer, behind this particular component manufacturer. Where is it going to? Where has it come from? What is the history behind it? And I think it's important to understand that context. Because if you look at it purely from a financial basis, it does look a very bleak picture overall. I mean, the numbers are not in the favor, but I think there's always merit in looking at something deeper than what the numbers are. So, again, I think our commitment to the space and sector goes beyond instant gratification and a commitment to just a commercial decision, commercial sense. We got to think about this as banks, and I encourage our competitors to do the same, is thinking about this long term. Thinking about country, society, economy, and you place that hat on, and when we
Is it just me, or have we lost Amit there?
It sounds like we might have lost him.
Right. Maybe there's a thunderstorm in the area where he's around. This is storm season in Gauteng. So let's see if Amit can join back. But I think we can continue on with the panelists that we have. And I think Amit made quite a good point there around the partnership, the great associations, the strength of this industry. Financially, it might not look that optimistic at all times, but we have the industry and the infrastructure. It is in place. There's a lot of reason to be very optimistic. But there's some elements that we're going to have to work on, and I would like to understand from this panel a little bit more about how do we go forward? How are we going to shift gears basically to adapt very quickly? How can we work together even better among the associations being represented here, the structures, the finance, the research, and with a view on what are the changes we need in technology and skills? How do we shift the way that we partner to be competitive going forward? So, Tete, I'll start with you, and maybe you can give us a view of that kind of thinking of the way forward, and how that's gonna what steps are required to expand the market access for our players in this industry.
It's an interesting one. So if we were to approach it from a point of what is Team South Africa's playbook, and this is neither a NACAM, NAMSA, but generally a South African playbook. We currently have a regional market that has incredible amount of potential for driving volumes. Let me give you a perspective. For instance, we're looking at about the African market in its entirety having about 110 million vehicles on the road for a population of about 1.4 billion. And this is, if you were to compare it, say, to India, that's got about 320 million vehicles for a similar size population. A per capita spend of about 2,700 versus 1,900 per capita for both Africa compared to, say, India, which is slightly higher. But the general structure of the predisposition is that you probably are 200 million vehicles short of where we could be, especially because even on the two-wheel side, we are nowhere compared to where India is, and micromobility is not at the same level for the continent versus India. So regional market development is a critical must-win, and from an Africa continental free trade area and those developments there, including trade in motor vehicles as of 3 weeks ago, 2 weeks ago, it's a development in the right direction. But how do we as a country clearly articulate what our must-wins are, and how do we then create a glide path that's easy for the country to adopt in accessing that particular potential in the market? Obviously, there's still other inherent challenges that we need to overcome from a region point of view, in terms of we're still a region that imports second-hand used vehicles effectively. They might not even be second-hand. Some of the imported vehicles into the region are even over 20 years old and so forth. And we're the only region in the world that imports other people's used vehicles. And so that needs to go down significantly. We don't have financial and reserve banks and interest rate environment that allows borrowing for purposes of acquiring mobility in the region. But again, we know what the problem is. So if you saying as Team South Africa, is there potential for us to really drive regional market development with a much more concentrated approach and much more deliberate intentions for purposes of supporting local manufacturing? That's a conversation to have, and I think it's an area we need to really drive conversations around, and that's one area where we could win as a country. Now, the other thing is, whilst we're talking about 1.2 million being sales that we're targeting for 2025, 1.4 million production, our current installed production is in the region of about 900,000 units, meaning we've got enough factory space to produce 900,000 units. And at our biggest peak in the past 10 years, we had around 700,000 units. So the one thing that we could also deliberately work on as Team South Africa is figuring out what would it take for us to up our production capacity usage to 90%, produce around 800,000 units, and what are the must wins in that being a short to medium term goal. And I mean, with that alone, we're talking about adding 44 billion into the GDP. And so these are meaningful conversations we could have, but we need a Team South Africa mindset in approaching how we move forward. And in that Team South Africa approach, a constituency-based reasoning and partner type of reasoning becomes a secondary conversation. And so yes, we need to have a Team South Africa approach, and Team South Africa approach requires that we take off heads of who we represent and we act in the best interest of the country. I hope that answers you, Hugo.
Yeah, no, brilliant. And I think the financing element is such a enigma. You know, it's a very interesting one for me, where you see do you think that if we were able to unlock the financing of these African markets, it's a cornerstone of being able to really unlock that market access and being able to get into that market?
So the right answer is, if you looked into the continent, West Africa, even in part of SADC, is the middle class growth is far much more, in terms of the growth rate, is far much more than what we experience in South Africa. So for a growing middle class across the region, access to finance then becomes a critical lever for them to be able to purchase new vehicles. And the existence of primarily a second-hand market with imported vehicles from other regions has got to do with the fact that whilst people can afford, they don't have the right tools to make the right purchases. So if we were focusing this conversation alone on the levels at which middle class growth is happening across the continent, West Africa, East Africa, then being able to finance asset acquisition through a financial institution, through a reserve bank system in multiple regions, and yeah, becomes an immediate lever that could have prospects of prosperity for locally South African produced vehicles.
Okay. So maybe I'll ask Beth on your side, you know, from a component manufacturer point of view, we know that there's latest tech coming into the market, EVs, and new technologies that's taking over across the board. How are our workforce skills keeping up with the changing technologies? What is the thinking from the component manufacturers to stay, ahead of that trend?
For sure. I know it's not necessarily always the world's most popular answer, and I think people want to feel like there's a huge jump shift or change. The reality is that the component sector, there is continuous investment, be it in technologies within the workplace, skills training. I think as an industry, we are really leading when it comes to workplace skills training. So for us as NARCAM, I mean, that's not something we necessarily, yes, it needs to be a priority. And yes, we need to look at how do we support curricular upgradings. And that's something that as the association we do on behalf of our members. But there is a lot of training that's already taking place within the industry. And that's whether it's ICE, whether it's EV, that will continue to happen. Maybe just on the NARCAM side of things, just as a kind of info sake, there's a Masita which offers discretionary grants. And so that's something that as NARCAM we utilize to try and develop a pipeline of skilled individuals which can enter the sector. And then companies obviously do their own workplace training once they've entered there. That being said, there certainly will need to be a level of upskilling and training once we are adopting new technologies. To a large extent, it's somewhat of a chicken and an egg situation at present. You can train the skills now, but they're not necessarily going to be utilized right away because we aren't producing a lot of those new technologies. And so it is a bit of we have to sit and wait and see where it is going. But I think, again, maybe back to your earlier question around collaboration, it is an area where realistically the answer can't fall solely on the private sector. It has to be done as a collaborative effort between private companies, the associations as NARCAM, NAMS, the government. And I think it is slowly kind of starting to take place. So it's happening. Certainly it needs to speed up, but it isn't something that I think is the largest bottleneck at present to the development or expansion of the South African industry.
So, and I was about to ask that exactly, that last point of yours, the bottleneck. So do you see it? It's not holding us back at the moment. It's not a burning platform.
It's certainly, I don't want to downplay it and say it's insignificant and it's not an issue at all. Certainly there needs to be skills development. There's no question about it, but I do think there's much more fundamental issues at play, which will determine whether we are pivoting into new technologies than just the skills kind of conversation. There's much more of a policy question. There's much more of a market demand question that probably needs to be answered before the skills question can be the poster boy for all of the issues.
Exactly. So it will follow on some of the other bigger major topics, but it's not to be forgotten. Absolutely. Thank you. So Justin, I'll come over to you again here in terms of, it's made a lot of the media all about the trade agreements. The US is in the news permanently. It's kind of died off a little bit now, but obviously it's it's having a big impact, kind of OEM movement into the US. The stuff we export there. We know there are other opportunities, so it's still focused on pockets where the kind of pain might be felt. How do you see those trade agreements potentially being other markets? Is there a big opportunity there for South Africa?
Yeah, there is. I mean, the challenge with the global environment is that these big shifts occurring globally are exposing our domestic and regional weaknesses. If we had a much stronger domestic and regional market position, quite bluntly, we'd laugh some of these developments off. Challenge is we can't, because that's where our volume goes. So the challenge we have is that we are overly dependent upon distant export markets. And these distant export markets are responding to market and political forces that are misaligned with where we positioned. And that unfortunately for the local manufacturers is really significant, because they're having to almost be schizophrenic, respond to a highly price pressurized, technology lagging domestic market, while simultaneously meeting the incredibly onerous and very rapidly shifting sort of demand framework in these highly developed markets. And you can see it in the comparative pricing, even in between our vehicles produced for the domestic market and the vehicles produced for the export market. So the key is, how do we take advantage of the regional market? And this is where we have big challenges, because And we've done the modeling to 2050. Africa could be consuming 6 million new vehicles by 2050. The challenge is that we are operating in an environment that is completely dominated by second-hand vehicle imports. And unfortunately, as long as you have second-hand vehicle imports, you will never have substantial new vehicle sales. And it's not because the second-hand vehicle imports are necessarily the best option for the consumer. It's because you cannot price the risk in financing an asset when you bring in a new vehicle in a market dominated by second-hand vehicles. So I've done a lot of work in different parts of the continent, principally over the last couple of years in West Africa. Their biggest challenge is they want to have second-hand vehicles and new vehicles. And the banks and the institutions are telling us we can't actually calculate the depreciation value on a new vehicle when any trader could dump 200 a lot of 200 second-hand vehicles at a fraction of the price of what they should cost because they're escaping some legislation somewhere else or have been massively discounted into that African market. The consequence of that is that these markets are going to be opportunities on a never-ending basis unless somebody's brave enough to stand up and say, we are no longer allowing the importation of second-hand cars. The price of second-hand cars must be set by the price of the new vehicle market, because then you can calculate the depreciation value and you can move away from the present model, which is essentially loading risk and putting personal surety into the acquisition of a vehicle and moving to an asset-based model, which does not exist in Africa other than South Africa. So for me, that's the absolutely critical opportunity. Now, if we take it to a regional level, directly around us, we have economies that are consuming 10 to 20,000 second-hand vehicles every year. You take a country like Namibia, imports 10,000 second-hand motor cars a year now. They should not do that, but they have no incentive not to do it because they have no local production. So we have an industry that's 100 years old and we do not buy one component. There's not 1 rand that comes out of the Namibian economy making for the South African automotive industry. The consequence of that is that they are not going to shift towards a new vehicle only market unless this industry in South Africa can find a way of building a regional value chain and giving them some skin in the game. They've got to be locked into the chain. We have to make our domestic market a fortress, and we need to make the regional market our operating environment. Failure to do that means we have to play in the global market space into distant, highly developed markets that are going to try and navigate the whole set of political and economic forces and technology forces that may not be appropriate for us. That makes us very, very vulnerable as a producer of vehicles.
Yeah, very interesting, Justin. So, it sounds to me like there's some kind of transition that's required. This dependency on these far-flung markets, as you say, with their strict controls. We can't just drop that. We still need to be able to play that game. But over time, we need to transition to understand how we penetrate our regional markets and even a little bit further than that with the right policy reform. I mean, is there any incentive from those governments to kind of also assist in blocking the import of those second-hand vehicles, or are they just happy to continue as is? I guess they've not really been incentivized to do so yet, as you say.
Yeah. So there's a slow movement in that direction. The countries like Egypt and Morocco do not allow second-hand vehicle imports. The Tunisians and the Algerians have very strict control, so they allow very limited second-hand vehicles into the market. The sub-Saharan African country that's made the biggest strides in this space is Côte d'Ivoire. So Côte d'Ivoire now has very strict age limits on vehicles, and as a result, their domestic market is now 30,000 vehicles for new vehicles. But based on their population profile and based on the number of middle class, they should be well over 100,000 vehicles. So their market is still contaminated by second-hand vehicle sales, but they have made the most progress of the sub-Saharan African economies outside of South Africa. So the challenge here is that the master plan emphasizes the importance of the first two pillars of the South African Master Plan are domestic market optimization and then regional market development. And the Master Plan endpoints 2035, and there's obviously a sort of a route map to get there. I can't remember the exact numbers for now, but for 2035, we are supposed to be selling 1.2 million vehicles in South Africa, of which 700,000 are made in South Africa and 500,000 are imported. So a big space for imports. It's recognized that you need to have a good model mix. We want serious volume production in South Africa so we can deepen the value chain and increase localization. But we obviously have that completely the other way around, right? We are importing far more vehicles than we are making for the local market. And if we exclude pickup trucks, so we light commercial vehicles, it's a bloodbath, right? The figures are horrific. Then we look at the regional market. We are supposed to be making 1.4 million vehicles, 700,000 for the domestic market and 700,000 for export, of which 350,000 are supposed to go into Africa and 350,000 are supposed to go into distant developed markets. The only target we've hit or are going to hit is the 350,000 into the developed markets. And yet that's where the new energy vehicle transition is happening. That is where the shift to vehicle autonomy is most likely to happen. So we are in quite a vulnerable state, and it brings me back to the focus on the domestic market. With some small subtle policy changes, we could rebalance what the domestic market is consuming. If we were to actually embrace our African position and work on a partnership basis with economies around us, we could build regional value chains. And if we did that, we would unlock all of these millions of additional units of opportunity regionally. That changes our entire geopolitical positioning as an automotive industry within the global value chain.
Yeah, so it's not just local, thinking local, it's also thinking regional, really unlocking those opportunities. So Amit, I'll come to you, and I've got two questions for you. I don't want to put you on the spot, but I don't know whether, from a financial perspective, institution perspective, there's any view or appetite around this kind of providing financial aid, or not financial aid, but the type of what's what I'm looking, the funding of these type of vehicles in Africa. Has Nedbank thought about this in any way, or is this still very far off in the distance for you?
No, I wouldn't say it's in the distance. It's definitely on the radar, but it's difficult for a bank to move without, the blueprint, business case, the POC, and having it been supported by policy. Because I think that's a recipe that's gonna no end, gonna hand us into a little bit of trouble pretty soon. So it's definitely on the radar. But I'm going to use an example. I'm going to use a practical example, and I think that's the best way to explain this. As much as we're trying to be proactive within the space and sector, we can't be proactive without the entire value chain working together and working collaboratively in this regard. One of the necessary evils of that we had not too long ago was load shedding, and load shedding, prohibited a lot of businesses from operating and trading. But that load shedding as a massive deterrent for South Africa and South African businesses, what that did do for us as a country was it rapidly increased the amount of alternative energy and the adoption of alternative energy. And as a result of that, as banks, all the banks, in fact, at that point in time, came up with very clever, interesting ways about going around financing this. And again, I'm not going to talk product specific. That's not the reason why we're here today. But we can basically do more or less of the same thing as banks. And I think this is another example where we're going to have to take the guidance of the sector and respond very quickly to that. Because, other than that, to Beth made a point earlier, it's a chicken and egg situation. Do we put the solution forward at the risk or at the cost of capital, and not have that return, which then could potentially put us in a negative space, for the foreseeable future? So a little bit of a chicken and egg situation, but I think where it needs to remain true is that we have to stay close to the pulse in this regard, because having a lag financier, we have to support this growth. Beth was making a point earlier on as well, and she was talking about skills and skills development. And actually, I raised my hand at that point, but I was so caught up in Justin's matter. I actually thought, well, hold on, let me listen to Justin properly. But when Beth talks about skills, as banks, we have a role to play in that as well. I mean, 4 out of 5 businesses fail as a result of financial mismanagement. So they could have all the technical skill, competency, skill set that they would get from any institution of whatever sort, supported by the likes of NARCAM, et cetera. But if you don't have that financial acumen and that financial support to understand that, you are ultimately going to end up in failure. So I think there's different spaces that as financial institutions that we need to play in, but do that where we are solving for a need and solving for a challenge, as opposed to doing something that has no sort of end in mind. It always baffles me when certain solutions are out there in the market, and I think to myself, well, what are you actually solving for? Does it necessarily move the dial forward?
Brilliant. Okay. Thanks for that. Thanks for that view, Amit. I'm just looking at the time, 5 minutes left of our discussion. So I'm going to go to our panelists, and my question really is, briefly, what's the future outlook? Where are the big opportunities? Let's end off on a bit of an optimistic note on the way forward here, and then we can open to some Q&A. So Tetley, I'll start on your side.
I think I've got to put in an application with Beth for one of those Merisita bursaries for my own education. Look, I think that if we were to be honest with ourselves, having an industry like the automotive industry in SA, and I know there was a comment around it being an assembly, but the value creation in the industry means we are actually a proper manufacturing industry. There is a report that shows that almost 45% of all value creation in the industrial sector in South Africa is in auto. And that comes from having a supply chain. And in our supply chain, we've got component manufacturers, even from raw material all the way to just people doing and manufacturing small little components that go into bigger systems, that tier 2 feeding into a tier 1 system. And having and keeping the automotive industry in South Africa is a primary must win for us. It's good for the economy. It means that we could put up technology-based training that's relevant, that's got immediate application. One of the few reasons Justin spoke about distributing our supply chain into the region and used Namibia as an example. So for instance, you'd assume it's easy for us to say the supply chain is that easily distributable, but there is no education system that is active in the region that's producing technicians that could feed into an auto supply chain for the absence of it in those particular markets. And so there is no ready TVET college training that you could say has prepared you for tool makers that will be able to feed into the auto value chain that we have in South Africa. So even if we're solutioning for it now with proposals around having a spoken hub approach in getting the region into the value chain, but you could see the absence of that particular industry in those regions means that you don't have a ready educational system, you don't have a ready supply chain, which we have in South Africa. So that's our primary must win. We need to keep South Africa in the auto producing space. We need to then work on competitiveness and make sure that we don't lose this industry. That's a must win. Thanks.
Brilliant. Thanks, Tetley. Beth, your final concluding words?
Yeah, so maybe just to bring some positivity as you requested from us, just to highlight. So we run a state of the sector survey, and whilst the negative part is that the outlook for the next 12 months remains fairly neutral to negative, shall we say, with continuous production volume reductions, etc. The interesting fact that we continually see, and we've seen this for the past 2 years that we've been running the survey, is component manufacturers are continuously investing, and a fair few are increasing their investment. And I think that speaks to the potential longer term optimism that there remains to be. From our end, I think kind of ditto what Tetley says, but really if I were to say where do we see the opportunities, as Justin said, a few small tweaks to policy, and I think we can see a fundamental shift to the growth trajectory of the industry. I also think there's other opportunities that we haven't necessarily fully investigated at this point in time. The aftermarket, the replacement market, We've got a relatively old car park here. What opportunity do we have at the moment to really expand that? Yes, there's a problem of imports there too. But again, if there's a right policy mix, and historically aftermarket hasn't really been part of that, that could unlock a whole new opportunity, and is certainly a big opportunity when you look into Africa. As much as there's great imports, there is opportunity to supply aftermarket parts there. And then really the final bit for us is diversification. And I think by that we mean markets. To Justin's point, how do we really expand, particularly Africa, but also Mercosur products? Historically, on our end, as the component side, we've been very focused on ICE technologies from an export perspective, with a particular focus on catalytic converters. So how do we diversify and potentially really expand within an EV component technology grouping? And now I'm going to slightly contradict myself and go double back onto the CATCON, or the catalytic converter side of the industry, and say that there's also an opportunity in the diversification of technology or vehicle platform groupings. As so much of the world is focusing on moving to EV, how do we position ourselves to say, well, we've got the right raw materials here. We could be one of the last of the catalytic converter export destinations and really pool in that volume. So I think we need to look at all means as far as possible to diversify, and in that reduce the risk to our industry.
Okay, interesting. I guess if the if the business case is still there in the short term, then that will, the numbers will tell the story. So
take whatever opportunities there are.
Exactly. Justin, over to you.
Yes, I think my frustrations come out of the realization of the opportunities. I mean, and the challenge here is that when we start doing sort of any form of value chain analysis, end of life vehicles, huge opportunities. Aftermarket components and accessories, huge opportunities. We have a 11 million vehicle park. We only have 3.5% of our vehicles being formally written off at the end of their life. All of these are major opportunities that create tens of thousands of jobs in other economies. We have a solid industrial capability in the automotive space. The fundamental problem is that South Africa does not take manufacturing seriously enough. And the auto industry is not going to thrive if the manufacturing sector doesn't thrive. It's part of an ecosystem. And the challenge that we have is that we do not have a conducive operating environment for manufacturing more broadly. And therefore, we are over-dependent upon narrow policies as mechanisms for compensating these very sophisticated large-scale manufacturers that we have. We will gain success when we tweak and adjust the auto policy, but that in itself is only going to take us a little bit further. We need to rethink what we want to do in the manufacturing space at large for the country. That needs to be dealt with, and then we'll see major movement, not only in autos, but in a whole range of ancillary industrial activity.
Mm. And I see a few questions on the Q&A here that kind of touches upon a few of these elements, and I would love to get into them. But before we go there, Amit, maybe from your side, your concluding remarks.
I just want to say, Justin has just secured my job for a couple of years by making manufacturing the center of it. So thank you, Justin. I agree. Manufacturing is at the center of it, and it's something that we can't hide and run away from it. I really don't want to be here and put up a sales pitch, but the reality is, we have a specific focus on manufacturing. We are zeroing in on subsectors within manufacturing. We can't be everything to everyone as a bank. But where we do play, we want to play extremely well, and we want to play with a tremendous amount of depth and understanding to make a tangible and fundamental difference out there in the market. So, yeah, Justin, thank you for some form of job security. Sincerely appreciate it. But yeah, I think, Hugo, jokes aside, I think on a positive note is that we're keen to see where the sector is going. We are by no means turning or closing off the taps, as bankers often use the term. I think it's a space that we will continue to look at with a certain level of optimism, because we know the potential and inherent potential that lays within the space. And again, I'm speaking specifically to manufacturing. That's my ultimate portfolio, but definitely a strong focus on the auto sectors and understanding the importance of this in the wider ecosystem.
I'm happy to see that collaboration and support can already take place right here on the panel. Hopefully that can filter through to the rest of the ecosystem. I've got a few questions from the attendees in front of me here, and maybe let's go through some of them. And I think one that kind of stood out to me when I kind of scanned through here initially was It says here from Henry, given the history of Chinese auto assembly in South Africa, does the panel feel that a local Chinese OEM plant will add more local value addition than the current OEMs? And we know that some of these Chinese manufacturers are looking to come into the country. But what's going to be the real impact here? Is this moving in the right direction for us? Justin, I see you look.
Yeah, I need to respond.
You came off mute there.
Yeah, this is a bugbear of mine.
Yes.
So first of all, we have to understand the global context. The Chinese OEMs who are making substantial inroads into South Africa are formidable global players. They provide a compelling value proposition. These are competitive players. So I say this from a level of deep respect for them. My biggest concern is what I read in the press and what I hear, and I'll do my best not to attack government, but when I hear comments like they need to start with semi-knockdown operations, I have a guttural response to that. We've been making cars for 100 years. Ever since the Fullion Commission of 1958, the first local content program of 61, we've been doing serious CKD production. So we've got 70 years now of serious CKD production. We do not need anybody to come into South Africa to show us how to screw 7 things together and get out our Allen keys and assemble some little, with due respect to take a lot sort of thing that we've purchased for self-assembly. If that is where we are going, we are in deep, deep trouble. CKD production lies at the heart of the value-adding ecosystem of the automotive industry. I am very concerned that people believe there are shortcuts to this sort of new future where we have a realignment of OEMs. Nigeria has 34 semi-knockdown operations. They don't make more than 10,000 vehicles a year. My garage at home is as sophisticated as most of the SKD plants that I've visited around the world. And I don't have a sophisticated garage at home. They are of no value to us. If they build CKD, great. Is there a business case for CKD? Not in the South African market. They'll have to export. Question then is, what is the export strategy? So I have a very, very hard view on this, and I'm very nervous that there are some serious decision makers who have no idea what the consequences are of us shifting to semi-knockdown for the future of our manufacturing base. It's probably my biggest concern in relation to the noise I hear from government sources.
So totally get you. I mean, it does paint a dire picture if we go in that direction. It's definitely not going to be fruitful for the industry. So how's industry influencing government in this decision making? I mean, there are many stakeholders to align, get around the table. What efforts are taking place currently? Because these guys are coming imminently. It's on the horizon.
I'd love to hear it from NAAMSA and NARCAM, but I think it's to make it very clear as to what CKD production means. It's assembly, it's a weld shop, it's a paint plant, and preferably a body shop. We can live without the body shop at the absolute minimum because there may be some limitations to what we can press, but certainly weld, paint, and assembly. And that requires at the minimum 4 or 5 billion rand in investment, and it requires at the minimum around 20,000 units of production of a model. Below that level, you seriously compromised in terms of the economics of production, which means you're back to putting Lego pieces together. And that's the bit we've got to try and avoid. So I think it's very clear. The question is whether the political heat is so severe that there are short-term compromises that unfortunately I think would result in a permanent damage to the industry.
Yeah. So maybe we can hear from Tetle, Beth, on this front, if you guys have a viewpoint on the topic.
Yeah, I was going to say that I guess there's 2 parts to that one challenge. So one, in the current APDP framework and in the current SAM 35 framework, SKD is not in the framework. So it means that if government so like if it means the existence of an SKD operation within the country is outside the benefit of APDP as a framework that auto and government has a compact on. And the sanctity of that compact means that government should also honor how it protects those that are within the compact to those that are wishing to operate outside the compact. And the challenge is that oftentimes when competitive issues are negotiated, and in this case, establishing a local operation for the non-competitive interest of the industry is what industry bodies are able to speak to. And industry would speak to the sanctity of the compact, which is APDP and Psalm 35. And industries will make submissions dissuading government from approving anything outside that particular framework. So in that one sense, industry supports exactly what Justin just spoke to. Now, the other issue that we have to also remember with possible Chinese investment in our market is that there is a magic number for their imports. I mean, some of these models that are now about to reach 30,000 new vehicle sales a year. And is that enough justification for a CKD investment locally for the local market without an export market outlook? Or is that enough case for which would be Chinese OEMs to produce local with the hope that then their growth would be into the region, and so regional market development then becomes how they structure their export market strategies and so forth. And for me, I think that we are reaching a point where the analysis of what would be a magical case number for local production purely based on local market demand for vehicles that you're already importing into the local market, and you have volumes in that particular level of about 30,000 or so. And the conversation itself is a practical one. If the rules they will exist within the compact, and it's going to have to be CKD, and that government should dissuade anyone existing outside that compact in these deals that they're making outside industry in the industry consultation, because these are negotiated outside the association itself, knowing what's been discussed for competitive reasons, and not exiting our mandate. So that is my addition to that conversation. But yeah, from a NAMSA point of view, the sanctity of the compact requires that we do not allow KDs.
So from an NAMSA point of view, very clear on the direction of travel, where we need to go here. So Beth, I see your hand up there from an RCAM or component point of view. What's your opinion?
Yeah, maybe let me just add in here. I think completely aligned with Justin, particularly in the component world, there is no space for SKD. You see almost zero component localization, even with assembly. The easy assemble components, in theory, your tire, your battery, etc. You're even finding that those are being imported. So for us, it's a very clear mandate. It's CKD production is what we want, and we want as high a volume as is possible to enable the localization. That's what ultimately is going to move the pulse for the component sector. We're not seeing it. There are a couple of SKD operations at present, and we're not really seeing that have any level of benefit for the domestic market as we speak. To maybe directly answer your question around what is the discussion that is happening, I mean, certainly without going into the details of it, there are ongoing discussions that I'm sure NAMSA is the same as us, but we continuously are in engagements with the government to discuss the need for there to be a very serious understanding of why we need CKD and those who are in SKD production to graduate into that CKD production as quickly as possible, really. Maybe the last thing to add is what maybe some people aren't aware of at present is there is inadvertently a kind of loophole within our tariff duty system, which is somewhat helping out SKD operations have a lower duty profile than what we see for CKD operations. And again, I don't think there's any secret in saying that we've been fairly vocal in saying that these type of loopholes need to be closed to make sure we're preserving CKD, because at the end of the day, yes, we might say, well, we don't really have the market at present to be attracting CKD investment, but as we attract SKD investment, what we're actually doing is eroding the case for the existing CKD. So we're not adding on. It's not 1 + 1. We're actually minusing from what we have, and we will be detracting from our current levels of localization and production. So mandate there and kind of purpose is very clear.
And so Beth, maybe whilst you're on that topic, and there's another question that caught my eye from Ogie. Whether, and so you say there are loopholes, but is there any appetite to, obviously we want to close the loopholes, but is there any appetite to go beyond that and put additional protectionist measures in place against some of the imports coming in? Increase hiking tariffs and all those elements. Can we protect ourselves further?
Yeah, for sure. All I can do here is speak from the perspective of NARCAM, and I can certainly say that as NARCAM, we have said there needs to be a proper review into the level of market protection we have at present. At the moment, and Justin, I'm sure can go into a bit more detail, but it's a very complex rebate-based system. And the end result at the moment is we equally selling rebates to independent importers. That alone is already eroding the level of protection we have in our domestic market. Our effective CKD and CBU duty rates, which is your vehicle imports and your OE component import rates, as NARCAM, we believe there needs to be an assessment into that and possible increase. That doesn't make us unique. If you look around the world, there's the same kind of tendencies being shown everywhere, and we certainly believe that that's something we need to look at if we want to seriously protect our domestic industry and in that grow domestic production volumes.
Justin?
Yeah, I think, this is a very sensitive issue, but it's really important. Our global peer group, Thailand has tariffs between 40% and 80% on CBUs. India is at 100%. Brazil is at 40%. We're at 25%, and we can rebate that down to zero. The challenge we have in South Africa is we have this complication where we have a 25% CBU duty rate, and then we have a 20% CKD duty rate. The spread's too small. And the consequence is that we do not have enough of a gap between the assembly duty and the component duty. And that has been compensated, the OEMs have been compensated through a rebate mechanism. The problem is that rebate mechanism is built on the value of production. So if a vehicle assembler exports, they don't pay duties on components for re-export, because that comes through on a duty flow-through basis, but they do get the rebate kickback on the value of their local activities. So if it's high-value assembly of high-value vehicles, we know which ones those are, what ends up happening is the vehicle assemblies who are very export-oriented earn massive rebates, far more than they could utilize for every import they bring into South Africa. And then, of course, they have to then monetize that incentive. And the way they monetize it is to sell it on. And then, of course, the importers, including the Indian and Chinese products that are coming in, are then discounted by the use of these rebates, which makes them more competitive than the domestic market. The problem is the root cause actually lies with the low CBU duty rate, not the low CKD duty rate. At 25%, we're much more aligned. Sorry, 20% on the CKD, we're much more aligned. If the duty was real. So the problem that the component manufacturers have is they're not actually competing with a 20% CKD duty rate. When it comes to exports, they are competing with a 0% duty, and when they're competing in the domestic market, they're competing with very close to 0% as well, which means they've really got to be competitive to win the contracts. And as we sell less in the domestic market, where there is a CKD duty rate on locally assembled vehicles, and we sell more on the export market, the protection under the APDP structure actually declines. So we've got some narrow policy tweaks and adjustments that could fix that. But there is a fundamental problem, and it's one that the government, and that's why I talk about take manufacturing seriously. If we see what is the problem we're trying to solve, what's the purpose of having an auto industry? It's not a vanity project. It's there to create value for our economy, provide jobs for our citizens, and create a high level of productivity and a tax base for the government, etc. What needs to be tweaked and adjusted to have those as the optimal outputs? And that may require an increase in the tariffs, especially on the CBU duty side. But one has to
so
be careful, because that would create cost in the market, which is not good for the consumer. So there's a tension here.
It's a fine balance, and it's a precarious position for government to be in. But and I think these levers, as you point out, has been highlighted in a few different forums now over the past couple of months. Do you see movement on this front, or is it a little bit of wait and see? Where are we going with this?
So this is tough. So I've been looking at some of the comments and the questions. The challenge, we're in a fiscally constrained environment. We're not a rich country, right? So we've got very low levels of per capita income. We do not have the resources of our global lead economies. So new energy vehicles, it's a problem with battery electric, for example. If we go battery electric, you've got to subsidize it. You don't subsidize battery electric vehicles; they do not sell. Don't let anybody kid you globally. The only time a battery electric vehicle outcompetes an internal combustion engine vehicle is when there's a nice big subsidy associated with the BEV. Take that subsidy away, people buy the ICE all over again. So you have to do the right thing, you have to find an incentive mechanism to do that. And of course, we're fiscally constrained. And I think what's happened with government is there are so many options, or not opportunities, but so many conflicting requirements and conflicting pressure points that it's almost resulted in stasis. The problem in this environment is the value chain is moving quickly. So if you have stasis and a lack of decision making, the consequences are going to happen anyway. It's not as if delaying by 6 months or 2 years allows you to buy time. No, it doesn't. It actually puts you further behind the curve in relation to where the balance of the value chain is moving. So you have to make some big decisions. The one is, and I go back to my original point, the master plan was very clear. We needed to optimize the domestic market, and we needed to have a regional market strategy. We needed to develop regional value chains. We've done neither. That exposes us massively. How do we create those? You fix those two things, even in a small way, there will be massive positive consequences for the industry.
Yeah, very interesting. And I think what I would just want to maybe, and I see our time is also running out. What I would like to kind of touch upon, you mentioned the thing about incentive mechanisms, and I see there's a question here for you, and how the kind of financial institutions are thinking about potentially bringing. Is there some innovation taking place there? I think the question from Ogie here says, can we incentivize uptake of locally manufactured vehicles, discounted financing rates, greenbacks, so the rewards that typically go with it, or other kind of cost savings? Is there a bit of out of the box thinking taking place? I don't want you to give away any of your secrets quite yet, but is this top of mind for the banking institutions?
Well, it's difficult to say something and not say too much and say too little at the same time. So yeah, it is top of mind. And again, with complete transparency, nothing on the current platforms, but I think one needs to look closer as to where we're going from this ICE to MEB migration, what's happening in that transition, and which part do we play in as a bank in that transition. Again, there's a lot of talk out there about this last mile stuff. I can assure you, we're not focused on the last mile stuff at this point in time. That's not where we see the greatest impact. But yeah, there's definitely some focus on how do we be more clever about this. And again, let's just keep it to that ICE to MEB conversation. Can we only sell maintenance costs at a cheaper price? Or as the green bank, as Nedbank, which is passionate about sustainability, and this is why we link into the NEB migration, is how do we better support that as a green bank and truly differentiate ourselves in market. So yeah, hopefully we can answer that question almost publicly, call it by H1 next year.
Okay, so I think we're gonna end it off there. I think we've answered some of the pertinent questions there. I have to thank my panelists on this one. It's been very, very insightful. This industry is in flux. It's such an interesting one to get into. So many different role players. Just looking at the representation we have on the panel, and how there's a big partnership that's required going forward. We need to bring in ourselves with the government and understand what are the options. What I wanted to say earlier, Justin, is, with your decision making, making no decision is also making a decision. And unfortunately, as you say, it can have quite dire consequences. So we need some action in this industry, in this, especially in the state that we're in. And I think we've got the right role players to move it in the correct direction. Big opportunities. We need to understand where the biggest bang for our buck's going to lie to make those opportunities work for us. So I thank again my panelists. Thank you very much for your time. Thank you very much for everyone's attention. I'll hand over to Shannon to close off for us.
Thanks very much, Hugo. That brings us to the end of today's discussion. A big thank you to our facilitator, Hugo van Wyk from EY Africa, and our panelists, Tsetle Liteko from NAAMSA, the Automotive Business Council, Beth Dealtree from NARCAM, Justin Barnes from TWIMS, and Amit Singh from Nedbank for sharing their insights, and to all of the attendees for joining us and contributing through your questions and comments. We'd also like to once again thank our sponsors, Nedbank and Metair, for making this webinar possible. The recording of today's session will be made available shortly, so keep an eye out for that link. We hope you'll connect with us again for our next webinar on the 3rd of December at 2 p.m. It will focus on critical minerals and is brought to you in partnership with Investing in African Mining Indaba. The link to register for that event was shared in the chat. And if you'd like to stay up to date with our upcoming webinars and news, be sure to sign up for our free daily newsletter or visit our website. You can also reach us at shannon@creamermedia.co.za. So from all of us at Creamer Media Webinars, thank you and enjoy the rest of your day, and goodbye.